Get back to credits. And we're on the American Opportunity Tax Credit. So I figured all of you would probably be interested in this one. It is a credit of up to $2,500 allowed for qualified tuition books for each eligible student. Room and board and student activity fees are not qualified expenses, limited to the first 4 years. That's important to remember, of post-secondary education. Qualified tuition, books, class fees, things like that. If a class requires a certain kind of computer, that would be a qualified tuition expense. But again, room and board and student activity fees are not qualified. So in order to be an eligible student, you must be enrolled in a degree program and qualifying accredited school, which I'm assuming most of you are. Must have at least 1.5 course load for 1 or more academic periods, includes each student in taxpayer's household if you've got multiple kids, including spouse and taxpayer. And the American Opportunity Tax Credit is not available to any student convicted of felony drug possession or distribution at end of tax year. That one, I hope, doesn't affect a lot of you, but I assume that the other 3 probably kind of do. So if you pay tuition during a tax year for a semester that takes place in the next year, credits allowed for the year amounts are paid, right? For cash basis taxpayers, like all individuals, you recognize it once that money leaves your hand. Qualified expenses can be reduced by scholarships, employer reimbursements, or educational IRAs. And this starts to phase out for AGI greater than 160,000 married filing joint and 80,000 for all others. That's married filing separately, head of household, qualified widow, and single. Up to 40% of the AOTC is refundable. So 40% can drop it below, but the other amount, I'll show you what that amount is, because you likely see it on tax returns. 40% is $1,000. So $1,000 is refundable, 1,500 is not. Now we're getting to the lifetime learning credit. This has no max amount of times you can take it. It is 20% of up to $10,000 of qualified educational expenses. Expenses not limited to the first 4 years. So you can take it as long as you're in school. The maximum amount of expenses to be considered is 10,000, irrespective of the number of students in the family. So now it does matter how many kids you have in college, and can be used only for tuition and fees, not course materials. So here you couldn't do it for books and computer if a class specifically calls it out, but you can use it for tuition. Post-secondary degree is not required. Students with felonies can still use this credit, and it starts to phase out for higher income taxpayers. Getting into other tax credits, residential clean energy property credit, that's a 30% credit allowed for cost of solar property placed in service through 2031. And it has to be qualified solar property. I've had people try to tell me that they bought a, rechargeable battery and try to do that. No, that's not qualified. It's got to be solar property. And the credit drops to 26% for 2032 and 2033, and 22% for 2034. And there's no amount that's available after that as of now. Congress, I'm sure, will likely extend that, right? Government will often give tax credits for things they want to endorse, and residential clean energy is something that they want to endorse. Does not include second home or vacation homes, so you can't get it for that. Taxpayers' basis is reduced by the credit, and unused credits can be carried forward. Savers credit, this is a credit that is from 10 to 50% of contributions to retirement account up to $2,000 a year. You must be at least 18 years old, cannot be claimed as a dependent by someone else, and must not be a full-time student. This generally is for low-income taxpayers. The government wants people to put money into their retirement. Some people don't make a lot of money and can't afford to, so they offer the savers credit that says if you put in money, you'll get some money back. And finally, getting to the foreign tax credit. This one gets to be a little messy, but it allows a U.S. taxpayer to credit foreign taxes paid or accrued against your U.S. income tax liability. The fun thing about being a U.S. income taxpayer is that the U.S. taxes your worldwide income. This is where foreign tax credit comes into play. You know, if you're off in Europe and you know, making $100,000 a year, the U.S. says, yeah, you're a U.S. citizen, we get to tax that. You can offset that with the foreign tax. Getting back into it, I like to digress on this topic. You can elect a dollar for dollar credit to deduct foreign taxes paid against income or to exclude the foreign earned income. You got to translate foreign payments into US dollars and you can carry it back 1 year or carry it forward 10 years. Generally, people are carrying it forward, but you do have the option to carry it back in. So here's the credit limitation. You've got your total US tax liability multiplied by your foreign source total income divided by your total worldwide taxable income. That gets you to your limitation. Foreign source is, you know, anything you earn overseas. Total worldwide is going to be your total US that you've earned plus your foreign earned income. So you take your total US tax liability multiplied by that gets you to your limitation. Getting into general business credits. If business credits exceed the limitation, they can be carried back 1 year and carried forward 20 years, similar to the foreign tax credit, but instead of 10 years, it's 20. Tax credit for rehabilitation expenditures, 20% of qualified rehabilitation expenditures on certified historic structures, subject to recapture if sold within 5 years. So you can't take this credit and then sell it within 5 years. You'll have to recognize that gain, or that credit rather. Employer provided child care credit, that's 25% of qualified care expenses, 10% of other expenses, and it's limited to 150,000. Disabled access credit, 50% of up to 10,250 over the first 250. And credit for increased research activities, 20% of excess R&D expenses over the base amount. Business credit limitation. So this is the total of all general business credits cannot exceed the smaller of, again, this is all these. Net income tax less 10 minimum tax and net income tax less 25% of net regular tax less 25,000. Basically just know that there's a limitation involved with it. Earned income credit, this is one you see quite a bit. Principal abode is US for more than 1/2 the tax year. Taxpayers between 25 and 64, not a dependent or a qualifying child. Married taxpayers must file a joint return. You can't do married filing separately and get an earned income credit. And disqualified income less than $11,000. So you can't have a whole bunch of interest income and still get the earned income credit. That's disqualified income. Okay, getting into the withholding of taxes. So special issues, more than one employer during the same year. What this is saying is there's that base of 162,200 for Social Security. If you make that through one employer, and then you've got a separate employer, you know, you've got 2 W-2s, they don't necessarily know that you've already met that ceiling. So they're going to withhold the normal amount, but that is the special issue. Income-based exemption, exempt professions. I'm trying to think what the exempt professions are. Clergy is one of them. Certain agricultural farmers are them. They're exempt from withholding these taxes. Backup withholding and special rules. The way the tax payments work is you have withholding from wages or pensions, or you can make quarterly estimated payments. The quarterly estimated payments, if that's the option you choose, generally, if this is me, I'm looking at a taxpayer and I'm looking at the prior year information. Let's say it was $10,000. I'm going to look at this and say, okay, I'm going to have you make estimated payments of $2,500. And this is when they're due. So quarter one is April 15th, quarter two is June 15th, quarter three is September 15th, and then quarter four is January 15th. There is a timing issue that occurs with this quarter four payment, where if you can recall from your Schedule A itemized deductions, you recognize it when you pay it. So even though this is due January 15th of the next year, you don't get to recognize that for Schedule A purposes in the current year. So let's look at an example of, let's pretend it's 2024 and I make an estimated quarter four payment on January 15th of 25. I don't get to recognize that for Schedule A purposes. But it would show up on my 24 tax return that I made it. Required estimated tax payments, so it must be greater than any of the following. So this is how you avoid underpayment penalties. You can either do 90% of your current year tax liability. So if I have $100,000 that's due on my tax return, and I pay at least 90%, I'm exempt from any underpayment penalties. And then the next one, we've got 100% of prior year tax liability if your AGI is less than or equal to $150,000. And 110% if the prior year tax liability is over $150,000. And finally, 90% of current year liability based on an annualized basis. So this step two, where this comes in handy, is I'll give you an example of a taxpayer that I had who was a lawyer, and then she went private, and her income jumped from roughly 150,000 to about $1 million. So, okay, so she makes estimated payments. How do we decide what her estimated payment should be? Well, I looked at it and okay, you made this amount in prior year. And I can't remember if it was less than 150 or greater than 150, but it's okay, this was your tax liability for that year. So let's just pay that amount and you're at least avoiding the underpayment penalty. So if her AGI was greater than the 150 and she makes estimated payments of 110,000, she's going to be exempt from underpayment penalties. Finally, we're getting into tax planning considerations, avoiding AMT. Again, you look at those AMT, generally the only people that are going to be paying AMT are extremely high income earners, probably think greater than $1 million, and who have taken excessive amounts of depreciation to drop their tax. So how do you avoid that? You make less, right? That's how you avoid taxes really, is you make less. But in this case, it would be, okay, let's look at how much depreciation you've taken, how much bonus, how much Section 179. Avoiding underpayment penalties, I kind of went over that just a little bit ago. Cash flow. So what cash flow is getting into is, in the case of the taxpayer that I was talking about, she probably had the cash flow to make greater than the 100% or the 110%. I can't remember. But she wants to hang on to that money. So she's going to owe a great amount at the end of the year. And she knows that. But if she can invest that money and get a 10% return, well, okay, she's making money by not giving it to the IRS. People that like to talk about getting a big refund, that they have likely over withheld on their W-2. And they're giving the IRS an interest-free loan, right? So if my tax liability is $10,000 for the year, and I say, you know what, I want my workplace to withhold 25,000, I am giving the IRS $15,000 to hold on to interest-free for me. I get that back, but that was mine to begin with, right? So what you generally want to do is owe the IRS a little bit. Getting a big refund, unless it's through tax credits, which, could be the case. Generally, tax credits aren't going to get you a huge amount, but they'll get you some. Generally, it's looking at, okay, what am I withholding and what's my tax liability? If my tax liability is 10,000, and I'm giving the IRS $25,000 of my money, and I'm getting $15,000 back, and acting like it's a treat. Like, well, no, that was mine all the time, right? I gave it to them interest free. I could have invested that money and gotten 10%. And then instead of, getting 15,000, I would have had, 17,000 or 16,500 rather. So it's beware of people that brag about getting a big refund. I run into it all the time, and it's generally not really understanding how a tax return works or how withholding works. So generally it's best case scenario to owe the IRS a little bit, because otherwise you're letting them hold on your money interest free. Finally, getting into general business credits and foreign tax credits and income exclusion. Foreign tax credits, I've got a client who was in Duluth, now they're over in Switzerland. So that's always kind of figuring that out for them. If you're a US taxpayer, you live abroad, the US is going to take as much as they can get. So some people just get rid of their US citizenship. Then once they become citizens again, that money gets repatriated. But generally, the IRS, if you're living abroad, they're going to try to tax everything that they can. And sometimes you run into that exclusion. Not a lot, but you do. And understand that there is a calculation that goes into computing that. All right, that is it for chapter 14. Thank you for tuning in. All right, bye.